What is a limited partnership in real estate? Are you thinking of raising capital or investing in a real estate partnership? You might be looking at a limited partnership structure, but do you really know what that is? In this video, I'm going to outline what a limited partnership structure is in real estate. Most investors generally confuse general and limited partnerships in real estate. In this video, I'm going to tell you the differences and what a limited partnership is. I'm going to share what a limited partner structure is and why it's one of the most common structures in real estate partnerships. If you want to raise money from passive investors or you yourself want to passively invest in real estate, then stick around. I'm going to show you exactly what a real estate limited partnership is and what to look out for when investing in them or structuring them. By the end of this video, you will understand exactly what a limited partnership is in real estate, when to use them, why to use them, and how to structure them. So stick around. I'm going to break it down for you. I'm excited for this video because I believe the limited partnership in real estate is one of the great benefits of this entrepreneurial country that we all are a part of here in the US. A limited partnership in real estate is a limited liability company. And when I'm referring to a limited partnership in real estate, I'm referring to a multi-member limited liability company, LLC. I do not typically talk about any of the other forms of partnerships because myself at Patriot Holdings, I've been in real estate 20 years now, and I focus on building these partnerships through a limited liability company model. So when we focus on limited partnerships in this context, there's a general partner and a limited partner. So the limited partners are typically the capital investors, the ones that put up the money, and they have a limited exposure, meaning they are not personally guaranteeing or on recourse for the debt associated with the property. And if there's any litigation or legal liability on the asset, they are not affiliated or associated with the litigation on the property. Now, the general partner is the managing member. They are the person that are responsible for the property or for the investment, and they are the ones that are typically recourse on the debt associated with the property, and they are the ones that are making day-to-day decisions. They are responsible for the management of the property. So I just want to break down the nomenclature here is when I say a partnership, that is also known as a syndication. So real estate syndications are real estate partnerships. And when I'm sharing a limited partnership in an LLC structure, what I really mean is the general partner is the managing member. And then the limited partners are just members. This is the technical way that the LLC is structured. And the general partner, limited partner language, that can be used to label the different types of partners. But in the LLC structure, we're talking about managing partners and member partners. Just want to make that clear. So what are the key roles for a general partner? Well, general partner is responsible for the management, for reporting to all the other partners. That means paying the bills, all the payables. That means collecting on rents, the receivables, and it means managing the overall asset. They're responsible for securing financing. They are normally responsible for finding the deal and structuring it in a way that they present the numbers to the other partners. They are the head quarterback of the asset or the investment. And with that comes the full liability of managing the asset and securing debt to it. Now, the limited partners, their responsibility typically is producing cash, being a capital investor, meaning they invest their capital and normally there's limited voting rights. They don't make day-to-day decisions and they are trusting in the general partner in order to execute on the business plan of the property. Now, they have limited exposure. They are not exposed to liability with litigation, and they're not exposed to the debt. If anything were to happen with debt defaulting or going into foreclosure, they are not liable for that. Now, limited partners are hands-off, but they are entitled to profits. And every limited liability partner is structured differently. And this is one of the great attributes of LLCs partnerships is you can structure them in a variety of different ways where C corporations or S corporations don't have that flexibility. So how are profits structured in a limited partnership? Well, that's a really broad question, yet I can give you some examples. In the very beginning of my career, I structured my partnership very simple. I was the general partner. I went and found the deal. I got the financing on the deal, typically owner financing. I would go out and manage the property. I'd hire the managers. I would do all the books with the reporting and the accounting. And then I had a capital investor. I had a limited partner. And that person put in all the money. And we split the profits 50-50. But the key point to that is the investor that put up all the cash had to get paid back 100% of their investment first, and then we're able to split in the profits. So that was the only thing I knew at the time. I was very unsophisticated, but it was a great structure. But I didn't really make any money until the property actually sold or we refinanced and I was able to pay back that investor. That's a common way of starting out. And it's not the typical larger private equity structure. So as I've grown in the industry now, the normal partnerships that I engage in with my limited partners, and I am the general partner, is there's a preferred return. This is pretty common in the private equity world. And when I say private equity, I mean general partners that raise capital from limited partners in limited liability company partnerships. And when we raise money as general partners, investors that are limited want a preferred return. That means that on their capital invested, they get a percentage return before anyone else participates in the profits. So it can range anywhere from 5% to 10% plus. So in the Patriot funds, we pay a 8% preferred return. So if an investor invests $100,000, that is their capital account. And each year they will get the first $8,000 of cash flows that come in from the properties. And that does not pay down their capital account. That is the return on their account or the return on their investment. And that's what they're entitled to first. And then next is the profit sharing split. So we typically call this a waterfall model. So anything above the preferred return, then the investors in the Patriot funds, it's 70% of those profits, and then Patriot gets 30% of the profits. And this can vary in any partnership. It can be structured any way you want. And if you're investing passively, look at what are the preferred returns and what are the partnership splits. And then there's something called a catch-up. So large private equity firms may do a 2 and 20 model where they charge 2% each year on the capital they manage as a fee to run their staff. And the 20% of the profits is after the investor gets their preferred return, but they have a catch-up provision. So what that means is that once the investor gets their preferred return and they start participating in additional profits, the general partner will tally up what all those preferred returns were. And then the next bucket of profits go to the general partner and they have to balance out that account. That's the catch up. And they're going to get paid now the accumulated amount of what the limited partners received in the preferred investment. And they're going to catch that up and then equal it out. And then the profits are split 80-20. And it's 20% for the general partner, 80% for the limited partner. Little confusing, yet that's the industry standard. And I want to give you insight into the larger private equity institutional world. You can structure your partnerships any way you want. I'm just highlighting here that the limited liability company, limited partnership is the preferred method for real estate partnerships. So what are some of the legal and tax advantages of a limited liability partnership? A big benefit for the limited partners is it's a pass-through. So the partnership doesn't get taxed at any level. It's passed through the profits, the distributions that go to the limited partners. So on the partnership level, the partnership is not taxed like a C corporation. It's a pass-through entity, and then each individual partner gets a K1, and on that K1, they will then pay their taxes instead of being double taxation. I don't even think that's a word, double taxation, but they won't pay double tax. Another benefit for taxes is the allocation of depreciation. In a limited liability partnership with limited partners, you can allocate more of the depreciation to the limited partners, meaning they're going to benefit from the accelerated losses or any losses that come through the partnership, and they can use those to offset other passive income because these are passive losses. And then other passive income from real estate activities they can offset and defer paying tax. It's a big advantage for limited partners that invest in multiple real estate partnerships. LPs get to enjoy in limited liability. So if they're not controlling the asset, they are not exposed to litigation or to any debt that comes due. They are only risking the capital or investment that they're making in the partnership. And to reiterate it again, the general partner is taking on the liability. Normally, like myself or other general partners, you'll open up a management company, and that management company doesn't typically own assets. And that's the decision-making entity that day-to-day is managing the partnership, the assets, and that is the company that's exposed to liability. So when do you want to invest or structure limited partnerships in real estate? Well, first, it's best for syndications or groups of investors. If you're investing with a group of individuals and there's a managing member or someone controlling the property, there's no better method. Using the limited partnership LLC structure is the preferred method. The limited partnership is great for raising capital. So if you are the investment manager or the general partner and you are raising capital and not putting in many of your own dollars, then raising the capital is best done through this limited partnership where the partners are protected and they can invest their capital without getting exposure to any of the liability of the operations of the company. So it's good to use this structure when there's a clear separation of management. When you have one lead general partner running and managing and making decisions for the property, and you have passive investors, there's no better format to do this than the LP structure. The LPs have limited voting rights, but they do have voting rights if the general partner is being negligent or irresponsible or breaking the operating agreement. But they are not making the day-to-day decisions on what money to spend or what assets to buy or sell. In these typical partnership arrangements, the general partner makes those decisions and he has to abide by the operating agreement, which is the partnership rules that the partnership needs to be performing by. And then the limited partners have a limited say unless that general partner does something wrong and needs to be booted. So I highly believe in limited partnership structures. At Patriot Holdings, my company, I started out the first 10 years of my investing career opening up limited partnerships. I would get a handful of investors that were the limited partners. I was the general partner. I operated it in a single asset LLC. And that was a great structure. And it was allowed me to go out and buy properties with friends, with family, with colleagues, with associates. And they got the preferred return. They got a lion's share of the profits. They did well. They made money, but I was limited on capital. I didn't come from money. I didn't have capital in the beginning, but I was willing to hustle, do all the work to find the deal, manage the deal, structure the financing on the deal, and sell the deal. And it was a win-win situation. I was able to build my wealth by making other people money. Those are my limited partners. And then to earn my promote or my fee. And that fee was after I guaranteed them a certain amount of returns, I was able to participate and get a return from the profits. I love this structure. If you're passively investing in real estate, please take a look at what are some of the key things in the partnership operating agreement. We're going to get into that in future videos of what to look out for in passive investment partnerships. And if you're an active partner, then use limited partnerships, limited liability companies. They are the best form of partnerships out there. So check out the next video and look at what to look for as a limited partner in limited partnerships in real estate.